Let me ask you something that I think is burning in the back of your mind right now. You've been watching the crypto space for months. You've seen Bitcoin dip, recover, dip again. You've watched Ethereum get built on, talked about, celebrated, and still underperform. You've read the headlines, you've heard the experts, and yet something doesn't feel right. The price doesn't match the story doesn't match the data, and the mainstream financial media keeps asking the wrong questions. Here is what they're not telling you. The rotation has already begun. The institutions are not coming. They are not planning to come. They are here. They are moving. And the window that retail investors have to position before that tidal wave of capital fully lands, is closing faster than anyone on CNBC will admit to you. Today I'm going to show you the mechanism behind what's happening, not the noise, the signal. Let's go. Welcome back. I'm the calm analyst. This channel exists for one reason: to cut through the emotion, ignore the hysteria, and give you a data-driven read on where this market is actually going and why. No moonboy fantasies, no panic, no cheerleading, just the architecture, just the math, just the signal. Today, we're going deep on three converging forces that I believe are going to define where XRP and the broader digital asset market moves in the next 60 to 90 days and beyond. Let's pull back the curtain. Let's start with the hard truth that most of the crowd is getting completely wrong. For the last several months, retail sentiment in the crypto space has been, frankly, bleak. People have been sitting on their hands, watching charts, checking prices in the middle of the night and wondering, when does this turn? And the answer most retail investors came up with was, it won't. So they sold. They rotated into gold, into silver, into speculative stocks. And crypto, Bitcoin, XRP, Ethereum, got left behind. And here's the thing, that sell-off was real. The pain was real. But what was happening underneath that sell-off is what almost nobody is talking about. Think about this logically. While retail investors were rotating out of digital assets, chasing gold's run, chasing the stock market's momentum, what were institutions doing? Because here's what you need to understand about how institutional capital operates. They do not react, they position. Retail reacts to price, institutions react to structure. And the structure that has been quietly, methodically, piece by piece assembled over the last 18 months is now almost complete. Matt Hugin from Bitwise said it plainly. The most important financial regulator in the world, the SEC, has now gone on record saying all assets will move on-chain. The largest asset manager on the planet, BlackRock, has its CEO on record saying every stock, every bond, every ETF will be tokenized. His CFO has put a timeline on it, 3 to 12 months to tokenize their entire ETF suite. And then, and this one stopped me cold when I read it, the largest credit manager in the world just bought a 9% stake in a DeFi protocol. Not a conversation, not a pilot program, a 9% ownership stake. That's not a company exploring crypto, that's a company claiming territory. Now ask yourself this brutal question. Why would the largest institutions in the world, firms that manage trillions of dollars, that have legal teams the size of small armies, that answer to pension funds and sovereign wealth clients, why would they be quietly building blockchain infrastructure if this was going away? They wouldn't. They don't gamble. They don't explore for fun. They position when they have certainty. And right now, they have certainty. The rotation you were watching, the one that looked like crypto dying, was actually institutional accumulation under the cover of retail fear. That is the hidden mechanism. That is the thing the mainstream financial press missed. While you were staring at the chart going down, the smart money was using your panic as a discount window. Now let's do the math that the crowd ignores, because this is where the story goes from interesting narrative to structural inevitability. Here's the number I want you to hold in your mind: $150 trillion. That is the annual volume of cross-border payments flowing through the global financial system every single year. $150 trillion. Moving through correspondent banking networks, through Nostro and Vostro accounts, through systems that were built in the 1970s and have not fundamentally changed since. And here's the cost of that system. An estimated $27 trillion in capital is locked in Nostro and Vostro accounts at any given moment, sitting idle, doing nothing, just existing as pre-funded liquidity buffers so that banks can settle transactions across borders. $27 trillion. Frozen, unproductive, dead capital. That is the problem XRP was designed to solve. Now let's run the supply math. There are 100 billion XRP in total. Fixed supply. That number does not change. Of that, approximately 55 to 57 billion are currently in circulation. The rest sits in escrow, releasing at 1 billion per month, and the majority of that is relocked. So the true liquid, tradable, accessible supply is shrinking over time, not growing. Now here's where it gets interesting. Ripple's on-demand liquidity product, ODL, uses XRP as a bridge asset. A financial institution converts fiat into XRP, transmits it in seconds across the network, converts back to destination fiat. The XRP is used and released in that transaction. But, and this is the part people miss, as volume scales, as more corridors open, as more institutions on board, the demand for XRP as a working bridge asset goes up. Not slowly, exponentially. Here's the math. If you want to move $1 billion through an ODL corridor, and XRP is priced at $2, you need 500 million XRP as a working float in that corridor. At $10, you only need 100 million. At $50, you need 20 million. Think about what that means. A higher XRP price actually makes the system more efficient. It requires less tokens to do the same job. This isn't a prediction, it's an engineering requirement. It is baked into the design of the protocol. And that design is now attracting the most sophisticated capital allocators in the world. Not because they read a YouTube video, not because of a tweet, because their quantitative analysts ran the same math I just walked you through and realized the system has a design requirement for a higher price, and they want to be positioned before that requirement gets fulfilled. The Forex market processes $7.5 trillion every single day. The derivatives market sits at an estimated $1.2 quadrillion in notional value. These are not numbers I'm inventing for impact. These are the actual sizes of the markets that blockchain rails, and specifically XRP rails, are being built to service. If XRP captures even a fraction of 1% of that liquidity flow as a bridge asset, we are talking about numbers that dwarf where the price sits today. This isn't a moonboy fantasy. It is a logical, mathematical outcome of the infrastructure that is currently being built in plain sight. Now let's stack the institutional evidence, because here is where the narrative stops being theoretical and starts being very, very real. Let's talk about what's happening at the Capitol. The Senate Banking Committee is actively moving on digital asset legislation. The Genius Act, covering stablecoin frameworks, has already passed with substantial bipartisan support in the House. 78 Democrats crossed the aisle to vote for it alongside Republicans. 78. That is not a partisan issue anymore. That is a structural policy consensus forming around the idea that blockchain-based payments infrastructure is not going away, and the United States intends to lead it. And why does stablecoin legislation matter to XRP holders? Because of what Congressman Patrick McHenry laid out clearly. Dollar-backed stablecoins are designed to be dollar-buying machines. Every dollar of stablecoin issued requires a dollar of short-term U.S. Treasury backing. That means as stablecoins grow, and they will grow, they become the single largest new source of demand for U.S. Treasury debt. The Treasury Secretary knows this. The Fed knows this. That is why the regulatory posture has shifted. That is why Paul Atkins, the new SEC chair, is signaling that all assets will move on-chain. This isn't deregulation. This is deliberate architecture. Washington is building the legal framework for a tokenized financial system, and they need Ripple and XRP to be part of it. Meanwhile, look at the fund flow data. Crypto funds just posted over $1 billion in inflows in a single week, the largest since January. That broke a 5-week outflow streak representing $4 billion in wrong direction movement. Bitcoin led with $881 million in weekly inflows. Ethereum pulled in $117 million, its largest weekly inflow since mid-January. And Solana continues to lead altcoins with $156 million in cumulative inflows in 2026 alone. Now ask yourself, where does XRP sit in that rotation? Because here's the thing about ETF wrappers. The reason Solana is seeing that capital is because institutional access has been unlocked through regulated product structures. The same thesis, the same access pathway, is exactly what the XRP ETF pipeline represents. And when that access fully opens, the inflows do not trickle. They flood. Matt Hugin didn't just say institutions are coming. He said, the Apollo and BlackRock, Uniswap, and Morpho moment told him it's right here, right now, accelerating at a pace that will make the world look completely different in 2 years. 2 years. Not a decade from now. Not after the next halving cycle. 2 years. Think about where you were 2 years ago in crypto. Think about how different the landscape looks today from where it was then. Now project that acceleration rate forward. The curve is not linear, it is exponential, and we are at the bottom of that curve's steep part. Let's talk specifically about what is in front of us right now, because timing matters. Tom Lee, who has been more accurate on market timing than most commentators you'll find anywhere, said it plainly. We are probably in the final stages of the correction, or we've already bottomed. He's looking toward April as an up month, and the macro setup supports that read. Here's what happened. Bitcoin and digital assets sold off sharply after Kevin Walsh was nominated as the next Fed chair, signaling to markets that rates might stay tighter for longer. That triggered a cascade of selling, specifically from long-term holders, OG Bitcoin whales, OG Ethereum whales, who liquidated on-chain positions in a very sharp window. That selling is largely done. The weak hands have already been shaken out. The supply overhang that was weighing on price has cleared. Meanwhile, other asset classes, gold, silver, speculative equities, that saw massive rotations in early 2026 are now looking extended. Geopolitical uncertainty is causing portfolio managers to reassess. And when money starts looking for a home that is borderless, sovereign independent, and genuinely oversold, digital assets check every single one of those boxes. Crypto is not just an alternative asset. It is a safe haven for capital that needs to exist outside of traditional geopolitical risk. And when the rest of the world is uncertain, that value proposition doesn't weaken, it strengthens. The near-term catalysts are stacking. Clarity Act moving through Congress. Genius Act framework getting finalized. XRP ETF pipeline advancing. On-demand liquidity corridors expanding. Institutional accumulation running underneath the surface. And sentiment, the single most powerful contrarian indicator in markets, sitting at historically bearish levels. The door is not closed, but it is closing. That is not panic. That is a factual observation of where we are in the cycle. Let me bring this to a point that I think gets lost in the noise, and it's the thing that separates the people who will look back on this period with satisfaction from the people who will look back with regret. Every major asset class in history has had a window where the infrastructure was being built, the institutional access was being assembled, the regulatory framework was coming together, and the price had not yet reflected any of it. A window where you could position before the crowd arrived. We are in that window right now for XRP and for digital assets broadly. This isn't the first time I've said something like that, but this is the first time the evidence has been this concentrated and this concrete. We're not talking about rumors. We're not talking about roadmaps. We are talking about the CEO of BlackRock publicly stating a tokenization timeline. We are talking about the largest credit manager in the world buying a 9% ownership stake in a DeFi protocol. We are talking about the Senate Banking Committee advancing bipartisan stablecoin legislation. The infrastructure is not coming. It is here. The institutions are not planning. They are positioned. The only question is whether you are. And look, I'm not going to tell you what to do with your money. That is not what this channel does. What I will tell you is this. The math I laid out today is not a guess. The institutional positioning I described is not a narrative. The regulatory architecture being assembled in Washington is not a rumor. The signal is clear. But only for those who are actually looking. Now, I want to be fair here because this is a channel built on rational analysis, not cheerleading. Let's steelman the bear case for 30 seconds. Ethereum. The argument is this. 60% of real-world assets are being built on Ethereum. The developer ecosystem is the deepest. The institutional comfort level with EVM-compatible chains is the highest. Tom Lee pointed it out. All this activity on Ethereum should eventually translate to price. And he's not wrong that activity should follow price, eventually. But the problem isn't Ethereum's technology. The problem is that Ethereum is an older architecture competing with faster, cheaper, more scalable chains. And now, with EVM compatibility and cross-chain bridges proliferating, the institutional moat that Ethereum enjoyed is being democratized. Any chain with EVM compatibility gets access to the same institutional tooling, which means the question isn't, will institutions use Ethereum? It's, will institutions only use Ethereum? And the answer to that is clearly no. The pie is getting bigger. Multiple chains will capture pieces of it. And XRP's specific design advantage, native bridge asset for cross-border value transfer, is not replicable. There is no other protocol with XRP's combination of speed, cost, and regulatory clarity in that specific corridor. That is a structural moat, not a promise, a fact. Here's what I want you to take away from this. The most important financial regulator in the world says all assets are moving on-chain. The largest asset manager in the world is tokenizing its entire ETF suite within 12 months. The largest credit manager in the world just bought a piece of a DeFi protocol. The US Senate is advancing bipartisan stablecoin legislation. ETF flows just had their biggest week since January. Tom Lee is calling for an up April, and on-chain data shows the OG whale selling pressure has cleared. That is not one signal. That is every single signal pointing in the same direction at the same time. The crowd is still looking at the wrong chart. They're watching the 30-day price movement, feeling the pain of the last few months, and making decisions based on sentiment when they should be making decisions based on structure. You and I are not the crowd. This channel exists because not everyone wants to react emotionally to a price chart. Some of us want to understand the system. And if you understand the system, if you have followed this analysis through to the end, then you already know what the system is pointing toward. The only people who miss major moves in markets are the people who chose noise over signal. Don't be that person. The math doesn't lie. The institutions don't position without certainty. And the window, right now, today, is still open. Comment signal below if you made it all the way to the end of this analysis. I want to see who the real ones are. Because there are two kinds of people watching this. The ones who understand what just happened in this video, and the ones who skip to the price prediction at the end. You already know which one you are. If this kind of deep dive analysis is what you came here for, subscribe. Hit the notification bell. Share this with one person who needs to see the structure instead of the noise. I'm the calm analyst. In a market driven by emotion, we thrive on data and composure. Stay patient, stay rational. And as always, we don't wait for the future, we plan for it.